They say the best way to learn something is to teach it. So that's why 2 days before my gender economics final, you guys get to hear about inequality caused by taxes. Everybody's favorite subject. Sorry if this is boring, but if you're an economist like me, this is actually pretty interesting. And especially if you're a feminist, you should know these things. The way our income tax system works in the United States is that, first of all, it's a progressive tax system, which means the more money you make, the higher marginal tax you'll pay. Now, a lot of people get marginal and average tax rate mixed up. There's never a point in our income tax system where by making more money, you're actually going to take home less money. That doesn't exist. That's a myth. The way it does work is that your marginal tax rate will increase. Now, what's a marginal tax rate? A marginal tax rate is how much you're going to pay in taxes on the next dollar that you earn. So, for example, I'm taking this directly from a homework assignment, so I know that the numbers are right. Take a couple, let's call them Jack and Jill. There's one earner, and that's Jack. He makes all of the money, but they're not married. Jack makes $200,000 a year. Makes a lot of money. That puts him in the tax bracket of $186,351 to $405,100 tax bracket, which means that his marginal tax rate is 33%. Now, that marginal tax rate is only being paid on the amount of money he's making over the $186,351. Now, if that's confusing, take Econ 101 and come back to this video later, because I don't really have time to get into the basic ways a progressive tax system works. But here we go. So, their taxable income is their total income minus a personal exemption, which they only get one because they're not married. And in this country, you're not considered a couple until you're married. And you can't file as a dependent, and you can't list somebody as a dependent unless you're married. Now, there are some exceptions, but in general, that's the rule. So he gets a $3,950 deduction. Then he also gets a standard deduction of $6,200, which is the standard deduction for being single. So to calculate all this out, we want to calculate how much net money is he actually paying in taxes. Based on this tax table, we look at the single tax table, and we say, okay, he's in this bracket, so we're going to take $45,353.75 plus 33% of the difference between $189,850 and $186,350. Basically, the difference between his total income and the bottom of that bracket. Okay? So we calculate that out, add it all together, we get that Jack and Jill are paying a total of $46,508.75 on their income tax. That means that Jack and Jill's average tax rate is $46,508.75 divided by their total net income, which was $200,000. And that gives us 23.25%. And their marginal tax rate is just how much money they would be paying if they earned one more dollar. So if Jack was to earn one more dollar, he would still be in that same tax bracket, so he would still be paying 33%. So that's his marginal tax rate. Let's say that they get married. Okay, so if they get married, then their taxable income is that $200,000 minus two personal exemptions, so minus $3,950 per person, minus $12,400. Their taxable income is already much lower than it was before they were married. Their taxable income is now $179,700. In addition, they get to move into the married tax bracket, which is a little bit more generous. So in the married tax bracket, Jack and Jill are in the $148,851 to $226,850. That's their bracket. In that bracket, their marginal tax rate is 28%. So you can already see that their marginal tax rate is lower. Now let's calculate everything else. How much are they actually paying in taxes? So you take that taxable income, and then you look in that bracket and you see that we need to calculate $28,925 plus 28% of the difference between their taxable income and the bottom of that bracket. So 0.28 times, in brackets, $179,700 minus $148,850. We calculate all that out, and we get $37,563. That means that their average tax rate is 18.8%. Now that's a lot lower than it was before they got married. So just by getting married, they've saved a whole lot of money. I haven't written down how much exactly they saved, but I'll put a little thing in text. So with Jack and Jill, their incomes were wildly different. In fact, Jack made all the money, and that's sort of the traditional marriage that we tend to see back when this tax code was thought up. And now we get to see how this discriminates against couples who make the same amount of money, but make it in equal shares. So let's look at Lois and Clark. So Lois and Clark both make $100,000 each. So their total family income is exactly the same as Jack and Jill. Now, let's look at the taxable income for Lois. Lois is making $100,000 minus the personal exemption minus the standard deduction. So in that case, her taxable income is $89,850. Then we look at the single tax bracket. Lois's taxable income is $89,850, which puts her in the $89,351 to $186,350 tax bracket, which means her marginal tax rate is 28%. We do the same calculations that we did before, and we find out that her total taxes paid are $18,333.75. Clark, her partner, makes the same amount, so together they're paying $36,667.75. So we see that Lois and Clark are actually paying less as a single couple than Jack and Jill were. But if they get married, then where are they? Lois and Clark, they're married, and now their income is bunched together, and the government sees it as just total income, which is $200,000, which means they're going to be paying the exact same taxes as Jack and Jill were. Okay? And if we look at that, that actually causes an increase in the amount of tax that they're paying and an increase in their average tax rate. Before they got married, they were paying an average tax rate of 18.33%, and now they're paying an average tax of 18.8%. So by getting married, by having an equal income, they're making less money than the unequal earners were making once they got married. Is that fair? It's up to you to decide. So that's just an example of one of the many ways that the way our tax structure is working is kind of working against women who are trying to earn more in the labor force. Well, it's working against anybody who is sort of in a non-traditional marriage where both people are making the same amount of money. So thanks for watching. Don't worry, we've got more car videos. And if you like this, let me know, and maybe I'll make some more economics videos. So, thank you.